There's a decision sitting inside your pension right now that you almost certainly never made, and it could cost you 216 grand by the time you retire. Well, that's according to this paper, at least. A 39-country research paper spanning 133 years of investment data. According to gov.uk, 95% of workplace pension savers are in their scheme's default fund. This is your future retirement plan. Probably the biggest pot of money you'll ever have, maybe even more so than your house. But do you even know how it's invested? In this video, I'm going to talk you through how your pension invests today if you do absolutely nothing, why this paper says there could be a better way, and I'm going to critique this paper and discuss the negatives too. Can't really be all sunshines and rainbows, can it? Surely one small tweak isn't going to make you an extra 216 grand? Let's find out. There's a rule of thumb in investing. Take 100 minus your age. Whatever's left, this is the percentage you invest in stocks, and the rest goes into bonds. So for me, at 31, in theory, I should be 69% into stocks and 31% into bonds. The rule says as you get older, you shift your portfolio from stocks and more into bonds. And while massively oversimplified, this is kind of what pensions do. In your younger years, they invest you heavily into the stock market, and your older years, heavily into bonds. For example, before de-risking, the default strategy allocates 70% to listed equities, 14% to bonds, and 2% to cash. After de-risking, equity allocation falls to 28%, with bonds rising to 52% and cash to 12%. And this makes sense, right? Stocks offer higher returns in the long run, but they're also risky. That's great when you have a lot of years in front of you. Bonds offer lower returns, but they're also safer. Perfect when you're older and you need stability. Take the risk while you're young, play it safer when you're old. This is the classic investing approach. And that's exactly why this study shocked me when I read it. Beyond the status quo. That's the name of this paper, originally released in 2023 and then updated in 2025. So the authors found investment data from 39 developed countries, going back as far as they could. For Denmark, France, Germany, the UK, and the US, they were able to go all the way back to 1890. Between all 39 countries, that's 2,600 years of combined market history. They then simulated 1 million situations for people. They used real earnings paths, pay rises, periods of unemployment, people not being able to invest if they earn under a certain threshold. They basically made it as realistic as possible to how life actually looks. They then found the optimal portfolio that came out, investing 33% into domestic stocks, 67% into international stocks, and 0% into bonds. Now that's their headline right there. But obviously it's not this simple. 2 investments and you're done. No, there's more to it than that, and we'll get into it. But first, when they say domestic stocks, this means investing into your own stock market. So for someone from the UK, that's 33% into a UK stock market index fund, or ETF, and 67% internationally. If you're French, 33% into France, etc., etc. On average, the couple save $240,000 or £180,000 across their working years. Investing into a target date fund, which is typically how pensions work, gave them $770,000 at retirement. Using the so-called optimal strategy of 33% domestic and 67% international, gave them $1.06 million. That's a $290,000 difference, or £216,400 at today's exchange rate. And with all that extra change in your pocket, you could almost buy a parking space in Kensington. London prices, eh? Still, 216k, it is a lot of money for one decision. And here's something that really surprised me. The optimal portfolio of 100% stocks isn't just up until retirement. I could kind of imagine that in the years leading up to it. But it also pretty much continues throughout retirement too, with just a small tweak for a few years that we'll come to shortly. But at this point, if you're thinking to yourself, this sounds like hangover-free wine. God, wouldn't that be amazing? But no, sadly, it's not real. Believe me, if you're feeling like that, I'm a skeptical person too. Isn't 100% equities just far too risky? What if the stock market crashes? What if you're a low earner or high earner? What if you're younger or older? What if you're American? Is 33% US stocks really enough for you? There's a lot of questions that need to be answered, and I'm going to answer all of these very soon. But first, let's give these guys a chance to explain how they got these results, if there is logic behind it, and then we can try to pick some holes in it. But quickly, I'd like to say, none of this is financial advice. I'm not a financial advisor. Investing is always risky, and you can lose your money. I just found this paper fascinating, and I wanted to share it with you. The main message from this paper, it's that bonds are not as useful as people think, but having a balance of both domestic and international stocks is actually much more useful than most people think. So let's take a look at some of the numbers and we'll see if that makes sense. I'm going to throw a few numbers at you here, but don't worry, I'll explain everything simply and exactly what we're looking for. So across these 2,600 years of combined data, bonds returned 0.5% per year after we factor in inflation. International stocks, 7.03%. Now that's not really a surprise. We already know bonds return less, but they're also less volatile too, which is a real benefit. Well, in the short term, yes. Over 1 month, bonds have a standard deviation of 9.5% versus 23.2% for international stocks. The lower the number, the better. So bonds clearly win this. However, over a 30-year horizon, bonds per year variance increases to 2.3 times the 1 year variance. In other words, they get more volatile over time. Whereas with international stocks, it decreases to 0.75 times. So they actually get less volatile as you expand the time horizon. But the real problem here is how bonds act in times of inflation. Bonds have a negative 0.78 correlation with inflation. That basically means when inflation rises, bonds struggle. International stocks, only minus 0.01, which is pretty damn close to zero. So in other words, international stocks, they're not really bothered by the inflation that's happening in your country. So what bonds do well is they protect you in an individual month or few months from the big crashes. International stocks, they're not great for this. If you invest in them, you pretty much have to ride out the crashes as well as the good times. But the research says that bonds kind of suck when it comes to protecting you from inflation. International stocks, they're pretty damn good. And here's the key point. Many of us are so worried about the big rapid drops in our portfolio due to market crashes that we often overlook the importance of inflation. The crashes are obvious to see. You can see them in your portfolio pretty quickly. But the slow, gradual erosion of inflation, it's hugely important, but it's not that easy to see. Also, consider this. Because international stocks offer higher returns, over a long enough period, the portfolio with them included, historically speaking, has climbed higher. As a result, even when a drop comes, the portfolio can handle it because it's built up more buffer room during the good times. Now, I'm going to say it straight to you. Crashes, they're guaranteed with investing. I'm not going to sugarcoat it. There's no way around it. But if you're also invested for the long term, they kind of don't matter as much as most people think. All of the years of good gains generally cancel out the bad crashes, and normally more so than cancel, they outweigh them. Okay, so all of this sounds nice in theory, but what about all of those questions we had from before? Isn't 100% equity, 100% stocks just too risky? What about your age? What if you're from the USA? Let's go through all of the questions. Isn't 100% stocks just too risky? Well, in the portfolios they simulated, the target date fund, a pretty common way for your default pension fund to run, that had a biggest drop on average from the peak to trough of 52%. The so-called optimal portfolio, 55%. So more, but not that much more, a surprisingly small difference. How about the bigger drops? Not the average drops, let's go bigger. Let's take the 95th percentile, the worst 5% of situations during the working period of your life. 81% for the target date fund, 77% for the optimal strategy. So actually less of a drop compared to the target date fund. But what about if you maintain the optimal strategy during retirement too? Again, in the worst 5% of situations. A 73% drop during your retirement years compared with 89% for the target date fund. Okay, but what about the risk of running out of money? Surely bonds keep the portfolio safe. Much better here, right? Well, for the target date fund, there was a 19.7% chance of running out of money. For the optimal strategy, 6.7. That's nearly 3 times less. But hang on a second. Both of these numbers, they seem pretty high, right? Uncomfortably high. That is because the authors assumed a 4% constant withdrawal rate, which carries with it its own flaws we'll get into in a second. But I should point out that both portfolios, they did have the same condition, the same 4% withdrawal rate. So when comparing, this is somewhat fair. And here's the kicker. Remember earlier when I said that the average difference at retirement between these strategies was 216 grand or $290,000? Well, the mean wealth at death was a much larger gap, 1.45 million quid or just under $2 million. And it doesn't mean you have to pass away with that much money either. You can do with it whatever you want. Go on a dream vacation, probably a few with all that extra dough. Pass it on to your family, help your kids buy a home, or you can buy almost 6 parking spaces in Kensington. Now we're talking. But what if market prices, they're just high right now? I mean, does this strategy still make sense? Come on, some of those AI companies in the US, looking pretty bubbly, no? So the authors allowed investors to consider the lagged price dividend ratio, a rough gauge of stock market valuations. And this is what they found. In the bottom quartile, i.e. when their domestic stock market is potentially undervalued, they invested 65% domestically and 35% internationally. No bonds. In the middle 3 quintiles, they invested between 28% and 31% domestically and 69 to 72% internationally. Pretty closely aligned actually with the original 33% domestic and 67% international. And still, no bonds. In the highest valuation quintile, 16% domestically, 75% internationally, and 9% into bonds. So bonds finally made it into the portfolio. However, even with this, to get the same amount of money at retirement, people needed to save 9.73% of their income compared to 10% for the optimal strategy. So in reality, what that means is the difference between these things is only a difference of saving 0.2% of your income while you're working. And that's before we get into all the research and complexities of trying to value a market. Yes, the USA, it might look overpriced with all the AI madness, or at least those companies specifically, but it could also continue like this for years. The reality is, we know a crash will come at some point because crashes always do. Trying to predict when, it's nigh on impossible. And as the numbers show, it doesn't even change the outcome of the portfolio that much anyway. So for me personally, that is just a game I'm not willing to play. I'm not willing to try to figure out how to time a market. Data says no. But what about the flip side of all of this? What if the US is actually just special and it will keep beating all of the other markets, as it has done in recent years? This is especially relevant for US investors. So the authors drew up this table. If an investor is 0% sure the US is special, then a US investor would follow the optimal portfolio just like everyone else. 33% domestically, the USA in this case, and 67% internationally. If they're 50% sure that the US is special, 60% in the US, 40% international, which interestingly is pretty close to what a global index fund lands at already today, give or take a few percent. And if they're 100% sure, then it goes all the way up to 100% in the US. But I will just say something to consider here. Firstly, bonds still don't make their way into the portfolio. That is interesting. Secondly, if you're 100% sure that the US will outperform, well, hey, honestly, that's your call. I'm not going to tell you what to do. It is simply not my place. But I will just show you this chart, because above the chart, this is when the US stocks won compared to international stocks, and below is when the international stocks did better. As you can see, the US since 1975, it has generally outperformed the rest of the world, but it also swings back and forth. And there is just no way that I could sit here and say with 100% certainty that this chart won't swing the other way at some point towards international stocks. In fact, I wouldn't even come close to saying that if I'm honest. If I had to guess, I would expect these oscillations to keep happening back and forth, exactly as they have done in the past. But what about if you're a higher earner or a lower earner? What if you can contribute more or less to your investments? Surely this changes things, right? Income levels and total lifetime earnings didn't change much. Combining both low or high initial income and human capital, domestic allocation remains between 32 and 33%, and international stocks between 67 and 68%. If you contribute 5% or 15% of your income, the optimal strategy remains exactly the same, 33% and 67%. What about the age you want to retire? All three ages they tested, retiring at 62, 67, and 70, gave the exact same outcome. You're probably starting to see the pattern here. Now, I mentioned earlier that what really shocked me about this paper is that apparently the optimal strategy, 100% stocks, 0% bonds, it just continues throughout retirement, not just in the years leading up to it, which, as I say, I could imagine, but in retirement too. Well, I did also say there's a slight caveat here, and there is a little detail we have to cover. So the authors, they compared two options, either the fixed optimal strategy we've discussed throughout, or letting things change based on age. With fixed strategy, it's pretty much 33% domestic and 67% international for your whole life. With the adjustments allowed for age, the optimal strategy, it was the same portfolio up until retirement. And then at the moment of retirement, they shifted 27% into bills, which pretty much acts like cash. However, this 27% drops down to 7% after 3 years, and by year 5, the portfolio is 100% back to stocks. So it's a change, but really only just for a small number of years. And what exactly does this change get you? Well, on average, it changes the amount you need to save during your working years to have the same retirement by just 0.07%, 10% or 10.07. So it's a tiny change, all things considered. And the paper acknowledges that this change really comes from the household's response to the sequence of returns risk created by the 4% rule's fixed real withdrawal structure. So in other words, this basically means this change only actually manifests if you are determined to follow a super rigid 4% withdrawal rate. If you allow your withdrawal rate during retirement to rise or fall based on your investments, then this switch to bills, it actually disappears. The optimal strategy remains 33% and 67%. And in reality, good financial planning involves adjusting your withdrawal rate anyway. Okay, but why is this 33% and 67% so rigid? I mean, considering the UK stock market makes up only 3% of a global index fund, 33% is pretty high for a UK investor, no? Well, they tested this and showed that there isn't actually much of a difference, going anywhere from between 11% to 55% in domestic stocks. So we actually have a fair amount of wiggle room here. And I think that's the key point. I think the paper isn't saying these exact numbers in 100% of situations you should follow. The headline here is 100% stocks. Just kind of crazy, with the exception I've already covered. It's how infrequently bonds actually make it into the portfolio despite default pension funds leaning on them pretty heavily. And it's to highlight the importance of international stocks. Let's say you're 80% invested in domestic stocks, your local stock market. This paper suggests that could be too high. If you're only at 1%, this paper suggests that could be too low. And if you don't like the UK stock market much, you're in the UK, you're thinking, well, 3%, that sounds about right to me. There is actually a real benefit to investing locally. If you're going to continue living in the UK for your life, the prices around you, they are going to affect your life. And being invested slightly more in the companies making those things, it's kind of like hedging your bets. That does make sense to me at least. However, there are some negatives about this strategy that I think that us as average investors, we need to consider. This optimal strategy assumes one major thing. You follow the plan. In other words, you keep investing at the exact same rate and buying the exact same things, regardless of what the market does. That's pretty challenging. Bonds can be psychologically easier for people. They don't have as large monthly swings as stocks. They are steadier in the short term. And for a newer investor, maybe this keeps them on the track to follow the plan. So the argument here for bonds is not so much a mathematical one, it's more of a psychological one. And you have to ask yourself, can you follow the plan in tough times exactly the same as in the good times. It's a real consideration you have to make for yourself. It's not one I can answer for you. This is your own personal psychology. This study also models couples from the USA, and their safety net, it's thicker than ours in the UK. The average couple receives $3,208 per month in the US for their state pension equivalent, just under £2,400. An individual in the UK gets £241.30 per week. So for a couple, that's £2,092 a month. So this is a real factor that you have to consider too. We all have to consider it. If you have a larger safety net, of course you can take more risk. But the truth is, not everyone does. On this channel, in front of all of you, I have made a lot of mistakes. I've never claimed to be an expert. I have a postgraduate master's in business analysis and management, but honestly, that is a long way off any kind of credentials that I would need to even be close to being an expert. I talked about Cathie Wood's ARK in the past. I first recorded a video about it on July 22nd, 2020, when the stock price was around $77. It briefly climbed up to $156, and today sits at around $80 at the time of recording. So basically flat over 6 years. The S&P 500 in that time, it's up 150%. Now, for those who are curious, I'm still holding. I never sold anything, but I hold my hands up and admit I was wrong. To be fair, I also shared that I was investing in Bitcoin at 4,200 in November 2018 and taking profits later at just over 60K in April 2021, which was nearly a 15 times return in 2.5 years. So it's not been all bad, but as I discussed in videos after that, honestly, I think it was mainly luck. It just made sense for me at that time in my life to take some profits. It turned out to roughly be near the top of the market, but I wasn't trying to time the market. I've always said that I don't want to do that. I don't want to get involved in those games. I just got lucky. But the one message that I've said throughout everything is diversification. Diversify. We should diversify. To me, diversification looks like a good idea. And it all goes back to a point that I will always highlight clearly. Diversification. But listen, I'm just a random guy on the internet. I make mistakes. I can't offer financial advice. I won't tell you what to do even if I could, because it's just not my place. And considering this is your future retirement plan, just do some research. Ask someone about your pension. If you're over 50 in the UK, you can actually access free one-on-one guidance from someone who is qualified. That's a service that not many people know about. And many pension schemes allow you to use £500 tax-free from your pension to access advice up to 3 times across your lifetime. I'll link both below in the description. One day, your pension is likely going to be the biggest asset that you own, more so than your house. So just find out what your pension is investing into for you. Maybe you change nothing. Maybe you do. Maybe you just want to leave it alone. That's completely your call. Either way, it is a pleasure to be back. Expect more videos soon.